David Bacher of Corion. Hey man, every month we get together, we talk about what's happened the previous 4 weeks, and every time there's some kind of turbulence, some kind of change to put us out of our misery. How was June?
June was in many ways the mirror image of the previous month. Last month, we spoke about how the rand weakness was really the driving element behind our market, and it materially and negatively impacted our equity and bond markets. If you remember, we cautioned investors not to panic. We felt that there was indeed value in many local assets. And fortunately for our investors at Corion, that actually turned out to be true during June. The rand clawed back not all, but most of its loss. Our bond markets completely reversed its losses. And our financial shares, which took a big whack in the month of May, more than offset what they lost. So it was a really good month for investors. And I guess it's another reminder that whilst volatility is a source of discomfort and mentally tiresome, it does pay to have your attention on the longer term and base your investment decisions on valuations and not just what's on your Twitter feed.
It's so important. When you have a look at the first 6 months of the year as against 2022, again, it's like a reverse mirror image. It's like you shined a mirror there and said, okay, so what did worse in 2022? Bitcoin. If you'd bought Bitcoin, you would have made 60% already this year. What did second worse? NASDAQ. If you bought NASDAQ, you'd have made nearly 40% already in the first half of the year. So why is it so easy if you just go and go and buy the losers and next time round you're going to win?
Certainly appears that way, but the tricky part is knowing your time frame. So when to actually get in and when to get out is very difficult. Unfortunately, no one rings the bell. And, that timing is what really makes investing very difficult. And I think there's been a lot of academic studying that, short-term investing and trying to time the market doesn't actually work. It's back to why we think you just got to take a longer-term view. You can look very foolish in being a professional investor with many, many years of experience over the short to medium term. You have to, buy for a longer term period in our view and stick to those fundamentals.
It's so important that had you bought NASDAQ 2 years ago and held it through this wipeout of 2022, you would have still been okay in 2023, recovered quite a lot of the losses. So again, what do you guys say? It's time in the market, not timing the market.
Correct. I love that analogy, and that's why we use it quite often. And over the long term, you do get rewarded for risk. And as I said earlier, it's hard to endure at times, but without that volatility, you're not going to get your inflation-beating returns over the long term.
Well, let's have a look at the Corion Report for the last month, and remembering that we are talking about a monthly setup. So let's just get that full screen. There we go, David. You see it nice and full screen, nice and pretty. You've been doing this for 6 years. That's quite a lot of effort, and I know you bring it out because we're talking on the 4th of July. As soon as possible after the month end. So you guys are really, burning the midnight oil towards the end of the month.
Correct. I think what's important in this world is simplifying investment as basically as you can. There's a lot of jargon out there. There's a lot of complexity, which I think the Corion Report does. But also, market information, there's a lot of theta and a lot of time decay. So what we've tried to do over the 6-year period is get the Corion Report out at 8 a.m. every second working business day of the month. And we've designed a whole process behind that. So, our subscribers, which is in the thousands now, can get it hot off the press, so to speak.
Well, they will notice exactly what you said earlier, that bonds were the best performing asset class, up 4.5%. Equities, we're talking about South Africans, in South African rand terms, up 1.5%. Outperforming slightly global equities, but on the way down, dollar rand, and that meant that the rand clawed back some of its losses, about 4.5%, and then global bonds down by about 4.5%. All of that, as you say, a mirror image
Correct. And, even our local equities, up 1.5%. The previous month it was, I think, down closer to 4, but there was a big dispersions in our local market last month. And, as I said earlier, financials were very, very strong. And what actually pulled down our local market was those resource shares, which, as you can see in the graph you're displaying, took a big snap.
So we had resources under pressure, retailers running like the clappers. I've been noticing this from the fantasy fund manager game, that the retailers have had an incredibly good run. I wasn't aware, though, that it was as strong as this. Woolworths up 20%, Mr. Price up 16% in the month. What was behind that?
Well, if you cast your memory back to the month before, and a lot of those retailers came out with market announcements and earnings updates, and they pointed to the load shedding impact and sales being heavier. And then you had the rand going out, which implies high interest rates for longer and probably rising interest rates. And that's not good for interest rate sensitive stocks such as Woolworths and Standard Bank. But load shedding actually didn't appear to be in such a dire state as was the previous month. And also the rand recovered, so putting probably less expectations of higher interest rates. So better consumer, more disposable income potentially, and hence you get that bounce that we saw.
Load shedding. We here in Homeowners have a very big Checkers, and they've got a very big generator. And when load shedding is on, because the whole town throbs with this generator that's going. But I'm sure the diesel that it's chewing up must be out of this world. And I think that we've got an interview, by the way, with Jan Oberholzer, the former chief operating officer, who's spending the next 2 years at least anyway, getting load shedding under control, which is quite positive, particularly towards the end of the year. So if he's right, or if that is correct, and we get those units coming back on from Kusile, and of course Kuberg coming back in with another 1,000 megawatts, and Medupi's one unit that is under pressure, or that's basically broken, that they're bringing back in by the end of the year. Would you expect then to see interest rate sensitive stocks, because of load shedding, actually doing better?
I think so, but you always remember that the pricing of a share is always looking forward. So it's always relative to what the market is expecting going forward. So, and that's partly why those shares have run so much. We've had a much better output from Eskom this month. And I think people are starting to realize maybe the doomsday scenario with Eskom and the complete blackout scenario is less of a risk than it was previously. And I think market dynamics play a part. We see at Corion a lot of people come to us with funding requirements and requests for infrastructure and energy, etc. So there's nothing like a crisis to solve a crisis, and I think we are adapting quite quickly in South Africa. Obviously, I say that with great sensitivity, because it's been painful for many people and many businesses.
Okay, here's a stat that's going to maybe make you a little less optimistic. Eskom spent 50% more in the first 3 months of this year, from April, May, and June, than it did in the whole of last year. It spent 9 billion rand on diesel for 3 months versus 6 billion rand for the whole of the previous year. So the reason why there's less load shedding is primarily because taxpayers' money is being thrown at it. But anyway, it is what it is. Financials had a fantastic run, as you say, up double figures for the month. Are we now to expect that, given resources were the ones under pressure last month, that we'll have another mirror image coming in July?
Well, that timing question is obviously key, which I find hard to answer and to apply practically. But, look at resources. You had platinum shares down 10%, a strengthening rand, two things you don't really want for commodity shares. I think through the cycle, given that these shares are down 20 to 25%, I think there will always be a demand for a lot of South Africa's commodities. So, based on that and where these ships are trading, I think that if you take a longer term view of resources and buy now, given their earnings potential, I think you're buying hopefully quite close to the bottom.
1.4% growth in South African equities. That's relevant when we have a look at the fantasy fund manager game. And well done, David, in bringing that to South Africa. We're very proud to be a part of the sponsoring team there. And top of the leaderboard for the month was Anthony Hall. He's an investment professional, isn't he?
It's quite funny that he actually works at Corion. He's a senior portfolio manager. And, we've had a lot of internal debates and discussions, and should he be eligible for the prize because he works at Corion? And we thought, the numbers are the numbers. There's no way to front run the fantasy fund manager. So, good for him, good for Corion. And, hopefully, he's only 1 month's return, but he's also adding a lot of value for our clients. So it's nice to have a little bit of a Corion portfolio manager leading the fantasy fund manager.
Well, for the month anyway. He's not on the leaderboard for the top 5 for the competition overall. That position leading and quite comfortably in front is Andre Klopper with 14.5% after July, ahead of Morley Talyaard. Do you know them at all?
I don't. What I do at Corion is whoever wins the week or the monthly, we give them a phone call and I introduce myself. So I think both those participants have just been consistent over every week. So I haven't had the opportunity to phone them yet. But if they win the competition, I'll be the first one to phone them and congratulate them.
Quite a lot of pressure on Andre now. Can you imagine? We're 2 months in, so there's 4 months to go, and he must be, not spending the money yet, but thinking 2.5 percentage points ahead. It's pretty useful. A lot's going to happen, though, in the last 4 months.
Correct. I mean, I was giving Anthony Hall a bit of abuse and some friendly banter a month and a half ago when I was comfortably beating him, and now unfortunately, like the markets, it's also been a bit of a reversal.
So the fantasy fund manager equal weighted benchmark was up 2.5%. South African shares were up 1.4%. Is this telling us that the fantasy fund manager players are doing better than the overall market, at least for July?
No, so what the fantasy fund manager benchmark is actually taking the 60 shares that are eligible for the competition and making it equally weighted. While our market is market cap weighted, so the likes of a Richmond, a Process, and Naspers, because they're so much bigger than other shares, contribute a much more significant weighting. So what happened last month is the equally weighted benchmark, which I think is a better representation of stock picking skill, did better because the bigger shares and the resource shares took such a hammering. But if you look over the competition, the reverse is true. So it's a bit of swings and roundabouts. Benchmarks are a way of judging performance, but you can use different metrics and come out with different numbers. You just got to choose what you think is right for what you're trying to do in terms of measuring your performance.
But is that correct? 84% of the players are actually in the black, made a positive return since the competition began?
Players with a positive return is 84%, while the market is down. I suspect, and embarrassing so, that actually does look like an error. I think it will be lower than that.
The other way around, maybe.
The other way around. Players with a negative return is 84%. Correct. Well picked up, Alec. I mean,
that's really good. Who needs fund managers if you can, Joe Public can do 84%. Anyway, moving on to the professionals and how the professionals did, the unit trusts. The best performer in the month was, the top 4 were between 6 and 7%. So that's a good outperformance for a market that was up 1.5%.
Correct. I think it's the nature of our market. You've got 2 big drivers or sectors in the market that do things very differently. So you've got the resources, which probably rely on a weakening currency, commodity prices, and you've got the financial interest rate sensitive, which factors are often very different. So what you saw last month is massive dispersions between those two sectors. So if you get your sector allocation correct, then you can have returns that are very different to your peers or the benchmark. And those funds that outperformed last month, no doubt, had much larger exposure to financials and interest rate sensitive shares.
And the worst performing unit trusts in the past year have been dividend generating trusts, or those that focus on high dividend payers. Why would that be the case? Because if you have a look at the only two of the unit trusts that have been negative in the past year to the end of June are both the one Satrix Dividend Plus Index Fund and the Signia Divi Fund.
So once again, if you look underneath what the actual unit trusts hold, you'll see a big exposure to resources. So dividend-paying companies, especially commodity companies, they pay a high dividend yield at the top of the commodity cycle. So those funds that follow a methodology of investing in high-paying companies would have gone and invested and been overexposed to resource shares, only for commodities to fall out of bed. And hence, because of the exposure to resources, those shares over, I would say the short term, 1 year is still quite a short term, investment horizon, has taken a massive hit. But, once again, a lot of research out there that if you invest in value or high dividend paying companies over the longer term, that often leads to outperformance.
Yeah, I guess the problem is, as you say, when you get to resources, this inanimate thing, iron ore prices, gold prices, who knows where they're going to go. And it's a little bit like you are a price taker. The inflows and outflows, I love to talk about these with you because it shows which stocks are hot or which companies are hot and not. On the inflows in the past year, Momentum Thematic Growth Equity Fund has had some huge inflows there. Is there any particular reason why that would be the case?
I'm not too sure why it's, those kind of numbers are quite big. So maybe it was one investment a client who's trying to go down a specific path. From a Corion perspective, thematic funds is not something that we so positive about. We don't get too excited. Themes come in and out. Timing those themes are often difficult, often centered a lot of hype. I'm not specifically picking on this fund per se, but thematic funds often have their day in the sun, but sometimes the clouds come in quicker than you expect.
Well, whoever put the 5 billion rand into that fund has got to be smiling, because over the past year, they have been really good performers, the growth stocks, which had fallen out a bit, of course, in 2022. So swings and roundabouts, as you say before. And then Old Mutual investors losing almost 1 billion rand in the month, in the past month. And then you've also seen, we've seen this Fairtree Equity Prescient Fund being the biggest loser of assets. Again, I think you did say that there was a particular reason for that, one big withdrawal.
Yeah, one client switched from one of their products to another. So I think it's a bit hard on Fairtree to focus on that. I think the Old Mutual Investors Fund is quite interesting. That was one of the biggest funds in South Africa. It was one of the first funds in South Africa. It's been around for ages. And it just shows you how quickly the South African landscape has changed. But that fund is certainly nowhere as big as it was. And you have what was in the early 90s or close to the turn of the century, the Allan Greys, the Coronation, the Foots becoming much more dominant in the South African investment market.
Yeah, Jack Mitchell probably turning in his grave to see what's happened to Old Mutual Investors. Tim Alsop also was involved there. Some really, really top fund managers who then went on elsewhere and did very well elsewhere. But it was the giant of the industry, as you say, no more. You got to perform in this industry of yours, David. You don't perform, people punish you, don't they?
That's the harsh reality of it. And I say a harsh reality. I think over the longer term, that should be the case. But often over the shorter term, investors tend to be a bit too quick to disinvest. That's our experience. There's been papers out there showing that the average retail investor's return is about 1% to 2% lower than what they would have been if they had stayed invested. And that's because they generally get out at the wrong time and they follow a cycle of fear and greed when they're not really investing over the longer term period and sort of chasing their tail too often.
Do your homework, get the right fund manager, and you don't have to change. David Bacher from Corion. I'm Alec Hogg from BizNews.com.